Good morning and welcome to today's premium account ASX Top 50 short form market update for the 26th of February. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, current Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, it is a short form update, so it's a quick summary of the macro issues impacting equity markets. We roll through a select group of stocks within the ASX Top 50. We look at their recent earnings results, the transactions that we've been concluding on our internal account and client accounts, and finish with a short form or a short-term market update, I should say. The services that we provide are up on screen there. If you'd like to know more about those, please contact myself, Leon, at investorsignals.com. Moving straight into a graph of the XJO. Now, our base case for equities is at around 15 times forward earnings, looking for around about 8 to as much as 10% earnings growth into 2014. The ASX is really at I think, approaching reasonably full value. There's select pockets of value, probably a little bit more upside in the banking stocks. The resource names, I think, are looking reasonably expensive after good earnings results and substantial price increases over the last 6 months. Some of the industrial names, again, are looking solid, albeit on high PEs. And our broad asset allocation remains the same, as where we're allowing a little bit of headroom in the banking stocks and the domestic property plays, but otherwise the rest of the market we're seeing as reasonably full value. Over the course of the next 6 months, I think, yes, we might get another week or two of the market pushing higher, but I think our base case is that equity markets, in particular the XJO, probably consolidates over the next 3 to 6 months. And what we're really waiting for in order for equity markets to push higher is confirmation that China GDP starts to re-accelerate and in general emerging markets stabilise. And really the key to synchronised global GDP growth is the Eurozone. We've seen the European Commission forecast reasonably tepid growth for the Eurozone through to 2015, and just to put that into perspective, growth in the Euro area is forecast to grow at 1.2% this year and 1.8% next year in relation to their GDP, and that's after 2 consecutive years of contraction. So it's not until we start to see that Eurozone really start to deliver on those numbers that I think you'll see any material wind back in stimulus from either the US or Japan, and therefore our base case is that equity markets remain well supported on any sell-off, and I think the range for the XJO could be back somewhere, back down at around 5,000 points, but equally in the weeks and month ahead, it could push marginally higher. But as we roll through the top 50 stocks, we'll look to identify where the value is. In the US market, we've seen a contraction in the Richmond Index of Manufacturing. Obviously, you've been watching and hearing in the news the severe weather conditions in the US during December may be impacting this economic data. We've seen the Case-Shiller house price index fall slightly across large US cities in its recent reading as well overnight. So at best, the data out of US is is certainly soft on the surface. Is it weather related? That's the big question. I think in the main, the US economy is continuing to recover, and again, emerging markets need to stabilise, and we need to see contributing growth out of the Eurozone to really get the markets moving again. So therefore our base case is consolidation in the months ahead. Alright, on that note, let's move straight into the top 50 stocks and take a quick look at the names. So AGK reported their results this morning, a little bit below expectation. The company will be paying a 30-cent dividend. The forward earnings outlook for AGK was reasonably optimistic, so you can see the stocks recovered quickly after the sell-off. Our fair value is around this 15.50, anywhere up around 16.50. The stock starts to get expensive, and we're selling calls up at near that level. In a lot of cases, we've sold the calls up at around 16.40 into the year's end, and we've collected around 60 cents a premium for those, so giving us an effective exit price of around $17 on AGK. Asiano, not doing there at the moment. There was nothing exciting in their earnings result. A little bit of cost cutting helped them to deliver a result in line, but otherwise limited revenue growth and limited earnings growth in Asiana. Amcor still on track to deliver 8% EPS growth in the 12 months ahead, trading on a high PE. Around $10, the stock's good value, up at around $11.25, $11.50 is where we're selling calls and capping out the gains. AMP not doing there at present. ANZ, so allowing a little bit of headroom in these banking stocks, but they're certainly getting pretty close to our target now, where we look to sell covered calls into the June-July period, collect the May dividend, and add to that yield out of the banks. ASX, a good earnings result here with ASX, slightly exceeded market expectations at around $37.50. The stock's getting expensive, though. We're capping out calls anywhere from $37.50 to $38.50 on ASX. They'll be coming up to paying an 88-cent dividend shortly. AZJ, the earnings result marginally sort of met market consensus. Our valuation range here is around sort of $4.90 to $5. And then up to around sort of $5.50, really looking for the stock just to consolidate and move sideways. We do own it at lower levels. We've capped it out at $5.25, giving us an effective exit price of around $5.50. BHP, strong earnings result out of BHP. We've got capital return to shareholders in the second half of this year. But again, given the run that BHP's had, trading on a PE of around 14 times on a dividend yield, just under 3.5%. We've taken the opportunity to sell $39 covered calls. We'll collect the upcoming dividend, and that really sort of sits where we see sort of full value for BHP, roughly around $40 over the next 3 to 6 months. Brambles, about 8% forward earnings growth. A favourable sort of trend today as some of the money sort of rotates back out of the sort of strong Aussie dollar and back into sort of favourable. We're seeing CSL and Brambles perform well today. Brambles is approaching its upcoming dividend of around 13.5 cents. The stock's expensive on any measure, so at around sort of $8.75 it's good value, and we're buyers of it at lower levels, but we've certainly started to cap the gains out anywhere above $9.50 in Brambles. CBA we continue to like, but taking the opportunity to sell $78 covered calls. We've collected the dividend on CBA. Coca-Cola, I think, is valued down here at around a 5% dividend yield, but a disappointing earnings result. We saw net profit fall by 10% there in Coca-Cola. Computershare, good earnings result here at Computershare, but a limited top-line revenue growth at around $12. The stock's expensive. We're not buyers of it again until we saw a pullback to around this sort of $10.50 range. CSL, the beneficiary of forward earnings outlook at around 10%. The company buying back $900 million worth of shares, and again sort of this trend where the markets in the last 24 hours starting to rotate back into the US dollar earners again. Crown, a little bit disappointing in the earnings result for Crown, albeit the Macau contribution continues to probably exceed most analysts' expectation, and most of the growth for Crown over the next 12 to 24 months will be coming through the Macau asset rather than the domestic casino assets and/or property assets. So our price target here for Crown is at around $18. We probably start to look to take profit after owning it at lower levels. I think it's in for a little bit of consolidation over the next 3 to 6 months before it eventually trends higher. Fox coming up to paying its dividend, albeit a fairly marginal dividend in the next week. The earnings disappointed a little bit, looking for around 8 to 10% growth. It came in marginally softer than that. The real news here is waiting for shareholders to vote through the delisting of Fox from the Australian market, and it's shifting to a US domicile listing. Goodman Group was a bit of a standout in the property plays, albeit compressing down to a pretty low dividend yield, but about 6% earnings growth over the next 12 months for Goodman Group. Our target is really around this $4.90 from a yield perspective. It runs into resistance. GPT, we own it at lower levels. We've just taken the opportunity now to sell the the $3.70 calls into June. We got reasonable premium for those, around 15 cents, giving us an effective exit price up here at around $3.85. I think that caps the upside for GPT. IPL, we've taken the opportunity to cap the gains here in IPL. I think at around sort of this $3 level, the stock starts to look reasonably expensive. Lendlease came out with its earnings results today after the market looking for results that will probably the market was expecting something to exceed on the upside. The result disappointed a little, albeit again forward guidance looks reasonably positive. So I think Lendlease sustains this price here at around 11 to 11.50. A day or two back, we took the opportunity to sell the covered calls at $12. We got good premium for those. So a combination of collecting that premium and collecting the dividend, we're driving well in excess of 10% cash flow out of Lendlease, and we own it at sort of off these lows here. So Lendlease sort of performing in line with our expectation, albeit the recent earnings result today was a little bit on the low side. In general, all the banks, our view is largely the same. Probably out of all the banking results, NAB was the softest, so we're reasonably well positioned there, with our preference being ANZ and Westpac. Newcrest, I've chatted a fair bit about that. The revenues were up around 12%. Gold starting to perform, their production starting to improve, getting back to around 2.5 million ounces a year. We're seeing strong demand out of China for gold. I think Newcrest can initially trade back to our target of around $15, and then we'll sort of reassess where the market's at. But generally, I think sort of with the high indebtedness of Western economies, I do think that gold should remain reasonably well supported. Origin has gone ex-dividend roughly 30 cents in yesterday, or 25 cents, pulled back to around 14.50. Our fair valuation for Origin is around $15. At that price point, the stock's compressing down to sort of a sub 4% dividend yield and trading on a relatively high PE. I don't think the earnings uptick for Origin comes through until 2015, 2016, so I'd expect to see sort of 6 months of consolidation at or near this price point. Oil Search doing well, so we're sort of drawn to Oil Search at around this $8 level. I see Oil Search trading up to around $9.50. Not doing QBE's earnings result sort of exceeded fairly low hurdle. The company had sort of downgraded earnings, and the results slightly exceeded market expectations, so we're starting to see QBE bounce off those lows. Rio, so iron ore prices are coming off a little bit. We've seen sort of some slightly weaker housing price trends in China come through over the recent days, and I think that's just sort of taking the edge off some of these mining stocks at the moment. We've largely capped, to the extent that we own Rio in client portfolios, we've capped Rio through selling covered calls at around $75 into the middle of the year. I think that's just an opportunity to drive some cash flow out of Rio, but really sort of Rio, BHP, Fortescue, I think now are pushing up against sort of their resistance levels. Stockland Group, around 4 to 6% EPS growth over the next 12 months. We've been buyers of it at lower levels here at around $4. I think it starts to get a little bit expensive. We try to sell the $4.10, $4.20 calls here, but Stocklands doesn't pay its dividend until around that June period. Santos. So Santos came out with a slightly disappointing earnings result, but again, the forward growth outlook for Santos looks solid, and the prospect of further dividend increases to shareholders, I think, underpins the price here. When it was up on its highs, we took the opportunity to sell the $14.50 calls, so we collect the dividend, we collect that premium, we own it at lower levels. I think sort of Santos fair value is back at around $14.50. Transurban is another name that we own at lower levels here. It's starting to recover. It's trading on around a 4% dividend yield. I don't see too much upside growth above sort of $7.25. It doesn't pay its dividend until sort of that May-June period, or June. So we'd expect the stock to remain reasonably well supported into the June dividend, and we're just assessing now whether we take profit from this current rally or whether we look to sell the covered calls and add to the yield of the stock, but certainly driving well in excess of 10% cash flow there out of Transurban. Telstra's gone ex-div 14.5 cents. I think it'll take a little while for Telstra to recover, but certainly into the middle of June we'd expect it to be trading 5.25. From an earnings perspective, the company delivered single-digit earnings growth at both the EBIT line and at the revenue line. There was good growth in the mobile division, and I think that sort of largely underpins Telstra, but our range is really sort of from 5 to 5.50. Don't see Telstra doing too much outside of that. Toll's set to report its earnings result and to go ex-dividend around 13 cents. Our our base case here for Toll is that at around 5.50 is fair valuation on about a 5% dividend yield, not looking for too much in the way of earnings growth over the next 12 months out of Toll. Westpac, one of our preferred banking exposure, we own it here at lower levels, up here at around sort of this $34. I think it starts to sort of capture full value. I think we look to sell the covered calls or take profit on the stock. I think, again, in line with the view on the broader index, maybe there's a smaller margin push higher, but then we'd probably like to see a little bit of a pullback in the market and some consolidation. Forward earnings growth for Westpac's about 5%, with the stock trading just over a 5% dividend yield. WDC, a little bit of a disappointing earnings result. The stock's already gone ex-dividend, so we've collected sort of 24 cents or so of dividend income here. Again, whilst the result was a little bit below expectation, forward guidance is reasonably strong. I think WDC can trade within our range of around $10.50 up to around $11.50. Anywhere up at around $11, we take the opportunity to sell the covered calls 6 months out and collect the upcoming dividend and add to that cash flow through the added call premium as well. Wesfarmers at around this sort of level here, the stock's reasonably expensive, compressing down to a low 4% dividend yield range, trading on a high PE multiple. Company should deliver around close to maybe 8 to 10% earnings growth in the 12 months ahead. Coles continues to be sort of the standout in the earnings contributor for Wesfarmers. We've sold the covered calls at around $44 into December. We collected $1.50 for those, so effectively giving us upside gains there in Wesfarmers up to around $45.50, and we'll collect the upcoming dividend there. Woolworths has been much stronger than we expected. We started to lock out gains really from this $35.50 level plus the 90 cents that we've collected in the call premium. So certainly didn't expect Woolworths to push much above $36 here. The company will pay somewhere around a 60 to 70 cent dividend. And their earnings results are released on Friday, so we'll watch those with interest. But the company's already flagged that underlying earnings growth within their range of somewhere around sort of that 4 to 7%, but probably at the top end of the range. I think the stock's still expensive here. Once it goes ex-dividend, I'd expect it to consolidate back down at around this $35 level. And WRT came out with its earnings result in line with expectation. We own it at lower levels here. It's trading at around a 5.5–6% dividend yield. We look to sell the covered calls at around the 3.20 to 3.30 level. It's already paid its 10-cent dividend, but limited earnings growth in the 12 months ahead there for WRT. All right, so to conclude today, within the banking sector, maybe a little bit more upside, but most of the stocks within the market are looking reasonably expensive. They're compressing down to a low dividend yield. Our strategy of owning the defensive names, selling tight covered calls over them, and sort of trying to identify value where we can sort of buy in on pullbacks and sort of take profit, as we've seen in the banking sector and the property plays recently, continues to add returns to portfolios. A lot of the stocks are obviously going through their ex-dividend period at the moment, so we're collecting those dividends as well as the call premium, and where possible we'll reset calls out into sort of that June-July period to drive extra cash flow. In general, portfolios are performing very well, and the asset allocations that we have are providing a good mix of sort of defensiveness to portfolios and the opportunity for strong cash flow off the dividends and the call premium. Thank you for listening in. I look forward to speaking again next week.